Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, January 19th, 2024. It's 11:28 a.m. Eastern Time as I'm starting the video. So we're a couple hours into the trading day, and here's what we're going to do. A very brief overview on the markets, because obviously nothing much has changed since yesterday in the technical posture or anything there. Spend a little bit more time, get a little more granular into fixed income, because that to me is... not everything, but a big part of where we're headed in 2024, or even in the near term. Again, I'll always tell you my long term outlook, and that's but I'm going to trade based on the short term posture of the charts and technicals, especially active trading. So we'll look at not just treasuries, but I do want to look at the other bonds out there. That's corporate munis, and I'll go through them real quick. I've got a watch list. We're talking a little over a half dozen charts. New trade idea for you. I'm going to show you Bitcoin. Been trading and watching Bitcoin lately, and we're at a downside target that I had. I'll talk a little bit on the ETF approval, but that's not my wheelhouse, but it is something worth noting. What else? Well, let's start there because... Again, to me, it's all about the big three. So let's talk about the markets. Let's start there because the markets are up today. But again, when you look at, zoom in, this is a daily chart of the S&P 500. And so what I'm doing is zooming in here. And this is that range I mentioned yesterday. We've been in for the last month and a half. That's really since the beginning of December back here. We had this breakout, that breakout candle that took out the previous highs right there. After some consolidation, and we've been consolidating here. Again, nothing has changed in the technical posture, nor will it, even if we went up a little bit more. If we go up a lot more, it will. It takes away these divergences, but what it doesn't do is take away the recent overbought conditions. So I still believe the RR is limited. The risk reward or the upside potential before at least a decent correction. I'm talking something that's going to take us back down to at least the breakout, test the breakout level. I think that is minimal. So the RR to me, despite the current trend, remains skewed to the downside, meaning, you have in my opinion, a better chance that the next 10% will be to the downside versus the upside. And of course, my longer term targets have much deeper levels than just a 10% pullback. So that's it. What I'll do now is I boxed in that trading range for you a second ago, but there it is right here. That's the S&P 500. Let's step down to 60-minute chart. You can see it again. I'm zooming in here. Here's your trading range. And that's it. And so we're effectively at the top of the range right now. TA 101 says when you're in a trading range, or trading 101, you can sell longs and or short the top of the range, swing it down, cover the bottom, and ultimately and or means do that, or wait for a breakout if you are bullish, if you're not concerned about the divergences, the overbought conditions, the other technicals I've covered. Then that's, it wouldn't be objective to go long here. It would only be objective. The only trade to make, in my opinion, again, it's my opinion, based on trading style, is to short or sell longs because you're at the top of the range. Likewise, the target, if we get rejected here, would be the bottom of the range. Quite often, I notice when you get a sideways range, the midpoint of the range will also act as support and resistance. So that'd be a minimum target. Let's flip over to QQQ. QQQ, I have a new trend line that I added here today. This is the only update that I've done to the charts on this 60-minute chart. That uptrend line comes off the late October lows right here. Got a couple reactions early on. This reaction here, when we had that bullish falling wedge right there, breakout. And so we had a divergent high there. We had a correction. We had a divergent low right here. You can see the divergence lines down below. We had a rally, and now we have another ever so slightly marginal and still divergent high. And not only is it, you can look and draw the divergence two ways. Here, I'll use a green tool here. You can have this divergence right here, because there's this kind of smaller little wedge. And the same divergence has been building all the way from back from this point. In other words, the indicators have been and continue to make lower highs. Showing you the momentum is waning, the buying pressure is drying up. There's no guarantee when you have, I always say this, divergences aren't a guarantee. They're not a sell signal, number one, and they're not a guarantee of a trend reversal, but they are very likely. They show a likely and imminent trend reversal, likely being well over 50% chance of it. In fact, in my opinion, it's based on everything I'm seeing here. This is probably a good solid 80% plus that we're going to have a decent reversal. Where to, again, my longer term targets, but just shorter term, if you look at it this way, just take this line here and this one, that gives you a nice, beautiful, here, I'll do it. Let me turn off all the lines, so I'll do it this way. Nice, clean, rising wedge pattern. And the measured target of a rising wedge pattern, you take the widest part of the wedge. Well, let me do this. Those drawing tool lines go away when I put any annotations on here. Let me find a clean board. I don't know if yeah, there's one. Okay, clean board. I'll replicate this with the line tools from the charting program so that I can do this. You take the widest part of the wedge, and that would be from right there down to here. You add that to where the wedge breaks down. That gives you a measured target. That's going to come in right around here. See this big old gap right there? Again, that's just a technical measured target, but you'd be surprised how often those are hit. So that would take you down to the top. And look, what I did there is assumed that we break down next week, Monday or Tuesday, because we have to first reverse. This wedge could certainly go a little higher. That's just your divergence line up top. This is a trend line. This is a support line. Divergence line isn't really resistance. It's just, again, what I just called it, the divergence line. And what happens is it goes away once you take out these previous highs right there, and you no longer have that. And then it's harder to make a case for that reversal. All right, that's your update on the Qs and SPY. I'm going to add that. There's that line right there I gave you. So on the daily chart, if you want to do it that way as well, you can draw the same wedge I just drew for you on the 60-minute chart right there, October lows. And your divergence line, there's your bearish rising wedge. You can see all kinds of support when I go back to the main board. What else? I already covered IWM yesterday. IWM down pretty good today. The QQQ is up. Story of everything, everyone just keeps buying these fangs thinking they're going to go up forever, and one point when it reverses, that'll be the biggest trade in years, because when money flows finally reverse and money's coming out of the market, it's a vicious cycle, and when you have a one-sided overcrowded trade, what happens. We had that with that orange juice short trade recently, and it was one-sided and blow off top, and it was still is down. I covered mine last week, but it's still going. I think it's still going down. Maybe I'll get to that in a second. But IWM has the most important thing. Again, this is just a recap. This it's not my tool here. Let me go for a circle tool. Ellipse, and boom, 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 false breakout, all the sell signals that identified in advance, meaning the overbought 76 extreme overbought level, followed by the bearish PPO crossover, which did the trick, then followed by the failure back below 199. So there were 3 reasons to be short. Oh, and then the trend line break, 4 reasons to be short there, and boom. And it, nothing goes down forever. As I said the other day, we're oversold. I said I wouldn't short it. This was 2 days ago. No, not yet, or not at that time. And you already, that was your objective opportunity. Now you wait for either some consolidation there. And we've consolidated for a few days, so we're working off those overbought conditions. 60-minute or oversold conditions. 60-minute chart has some divergences, so kind of maybe just wait and see if these divergences get taken out. In other words, right now, I don't see a trade on IWM because of the recent failure, the big breakout. I have nothing's changed. As I said before it even happened, that it likely would happen, and then the most likely scenario is we go back at least to the bottom of the range, which is all the way down here to 163. So therefore, any bounces I'll view as counter trend bounces and objective shorting ops. Being that we already had the failed breakout, it would be a gift to get 199 again. I'm not guaranteeing that you can't go up through there, but I don't think we'll get it. Usually when this happens, you get a lot of trap longs, shorts got blown out, and so you really rarely get that opportunity to kick back to the same resistance level there. So there's IWM. All right, let's roll into, before I get too much into rates, I don't want to forget. Let me cover some Bitcoin stuff for you. I'm a futures trader, but I'll get to the ETFs. There's going to be some new ones now. You guys, if you've been keeping up with the headlines, much to the chagrin of the SEC, they've approved the Bitcoin ETFs. And what we've had before, you might say, oh, Randy, there have been Bitcoin ETFs around. And again, please, full disclaimer, this is not my area of expertise, Bitcoin or any of these, but this one's been around for years. And it's not an ETF. It's an ETF-like instrument. Operates more like a closed-end fund, which means this thing trades at a premium or a discount, and it could be substantial to the price of Bitcoin. My guess is longer term, that's going to be bearish for this one as money goes into those ETFs that are more closely regulated. I think you'll probably see this guy start to wither away. Funds get siphoned off this, and then it may trade or likely would trade at a discount if it's not already. I don't know if it's trading. You can go to their website, it's Grayscale, and they'll tell you how much at a premium or discount to the price of Bitcoin it's trading at. Now that's bearish, divergent high. So that's, it was recently, it's aggressive, and they were coming out with that stuff, but I took a little shot on based on the futures. And this one could have some more downside, and 33.30 would be a pretty decent support level. You can see you take this line across, and then the uptrend line. I take this chart with a little bit of a grain of salt, again, because the fact it can trade at a premium or discount. We're seeing a lot of volatility. Let me show you spot Bitcoin prices and the futures, and then we'll go from there. Okay, this is BTC. This is crypto that you can buy through at least through this broker, Interactive Brokers, and it's the actual crypto, and it's on this Paxos network or whatever. This is a 6-month chart, as you can see here, 3-hour candles. And so there was a divergent high. This was all the hype leading up. It's what they call buy the rumor, sell the news, and get the approval. But then you had big negative divergence. And look, this divergence was big, and we could see more downside. So what I'm gonna tell you right now is simply the levels that are likely to produce a reaction, and that's why I'm doing this video right now. And that is exactly where we are. You can see my lines. I have a horizontal line here. Look at all these reactions here. Boom, 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 boom. And that line's at 40,560 right there, and we're there right now. So we've had a nice pullback off the highs, and a little bonus here if it reverses off that level. Again, big divergent high. It wouldn't shock me if it goes down through. If it does, there's a tiny little gap in the middle there. You could put minor resistance about 39,000. You can see the blue box on the right. But this is the next solid or pretty decent support. It's all the way down to about 38,027 is where I have it on my chart. Again, I think this is an objective long entry with a stop somewhat below in case we do enter that, break that support. And like I showed you, positive divergence. I might even be able to give you a little downtrend line here. I don't want to force it, but you kind of get, a little bit of a wedge type action going on there. So there it is. There's your trade idea. Now you could go with, I don't know when these ETFs are going to come out again. I don't follow that stuff much. More of a futures guy, but if they're not out, I don't think they're out yet trading. Again, maybe I'm wrong. You could buy GBTC. It'll move if this goes up. So there it is. There's your trade idea on crypto, Bitcoin in particular. And for you futures traders, there's that beautiful look right there. 41,123 in the bottom. I'm talking about this gap right there. 40,207 rough. We'll call it 40,200, and we're right there right now. So again, positive divergence. You've got some reaction highs there, and then a gap right there. And so we entered the gap, and we're at the bottom of the gap right now. And you have some positive divergence. It's unconfirmed. We need to turn up, and then these indicators will turn up and do what I call confirm the divergence. And if not, don't get married to it, because there's, again, I'm just viewing it as a buy the rumor, sell the news. I understand the potential could be ginormous. I know this, the crypto bulls, their thing is, now that the ETFs have been approved, even if all these massive pension funds out there and everything ultimately just put a small fraction of their money into those Bitcoin ETFs. Now they have more validity with the SEC approval. Then yeah, the market's huge. So again, I'm kind of agnostic to whether it's going to be around in 5-10 years from now. I know it's highly risky. I'm just showing you levels. You guys do what you want with it. There it is. There's BRR, Bitcoin futures. Ethereum. Okay, I didn't even have the Ethereum chart marked up, but I just did. I just pulled up and I went to a 2-year, just kind of glancing at it. See, you've got a lot of big negative divergence here, and these things good, but that's Ethereum too. I don't know if there's any Ethereum ETFs in the works of being approved, but either way, that's the actual crypto divergent high. I would not be a buyer of it. That's just me. Like I said, Bitcoin. I just made a case to for bounce trade. Here's some support. If we do get a correction in Ethereum, obviously it tends to run with Bitcoin, so it's had a lot of nice lift. Again, this is a 2-year chart you're looking at, guys. This is not a 60-minute or anything like that. Here, I'll just for kicks and giggles, let's go down to a 6-month, 3-hour chart. Yeah, I can see some support right here, right where we're at right now. Next support is going to be all the way down here if that breaks. So there's your levels on Ethereum, ETCG or ETHE, either one. I think this is the newer of the two. That was a divergent high, and it's been moving lower since. So big divergence on Ethereum. Thing about if Ethereum, this chart to me looks bearish. I wouldn't buy it again. I'm out of it right now, but I don't know how much Bitcoin's going to bounce if Ethereum starts to come down pretty hard. So I just wanted to go over that with you, and also show you, tell you my convictions aren't super high. I showed you what I believe is an objective entry. Also looks kind of like a blow off top here on ETHE right there, and that could have more lasting implications and really take this thing down. If and when it gets here all the way back down to 1228, I might be interested. But remember, that's going to be a drop of 46% off the recent highs from last week. Okay, what else do I want to show you? I was going to talk about the grains. They're moving today. I threw those out to you yesterday. I also threw out silver, gold. Silver's still at the same support level. Right here. This is that 3-month hourly chart of silver. And then you had SLV. It's still, silver is above that wedge. Not really moving much, but remember, this is a really nice support right here on the daily chart, about 2050. 60-minute chart, you can see it there as well. So really no change in silver. I still like it. I still think just like I showed you Bitcoin, it's at support with positive divergences. That's kind of my trade. Take it, don't second guess it. Obviously, if the euro moves down, which it's going to most likely take for a decent pullback in the stock market, then that will most likely put pressure on gold and silver. So as with any trade, don't get married to it. Pick your stops. Your stops are going to be commensurate with your price targets. So everybody's different in your entry price, but I've been highlighting it here for the last few days. And again, so it's had a couple punches below. And here's the thing. Let me address that, because you know what sucks in trading is when you take a trade for all the right reasons like this, and it does this, and it stops, it goes out, just runs your stop, and then it takes off. Here's the thing. You can always get back in. So if they have a little washout move, a stop raid, and it comes back above 2060, that's where you can jump back in. So it's not the end of the world. But what you don't want to do is continue to hold and hope that it's going to do that. And sometimes, in that case, it was a lot more downside, and there's nothing to say it couldn't have done that. So, that's I've done this a long time. You can have weeks and months of nice gains in your portfolio and just one bad position, especially if you're overly concentrated in that position. And it's something that moves a lot, like silver or natural gas or Bitcoin. It can wipe out months or even years of gains and set you back. So don't do it. Don't let them take it from you. All right. Okay, let's get into bonds, because that's really what I wanted to cover here. And so we know what the tech trade is. Everyone's loves those tech stocks. So they up today, started to hit a little wall after popped up today, but really hasn't gone much further than where it peaked right before I started this video. We're starting to drift back. And the big thing are bonds. I'm going to go through those now. As I said, I have a high degree of confidence that, well, I had a high degree of confidence where we're short treasuries after being long, but we would continue down, meaning yields up. These are yields. So this is treasuries in reverse. And so I'm just going to kind of recap this. We're going to look at various charts. There's that price channel in the 10-year. This is the 30-year, 30-year yield. It's been ticking up. There's some resistance right around this area. There's also a back test of this trend line right here, and that's important to note. I'm going to tighten that trend line up to back here. Let me see how it looks. It's not my primary trend line, but it is an uptrend line. So the million-dollar question, and again, I think there's a good chance we can do this. Whether we pull back first or not, I think we go higher. And what I feel, I have a very high degree of confidence that if and as we go higher, again, whether it's not, it doesn't have to be immediate. It can be like this from here, or we come back a little bit, market stocks like that, and then we start to go up. Again, it's from this point incremental, whether it happens next week or 3 weeks from now after a pullback in yields. I think you will see the stock market increasingly act negative if and as yields continue to tick back up. Because right now my take is this is the market just figuring, okay, we had a really nice pullback in yields, one of the biggest pullbacks in months, if not years. Nothing wrong with a little counter trend bounce. We're going to continue to do this. That is the market expectations. I can tell you right now, vast market expectations. So, and you can see it by stocks really kind of shrugging this off so far. Stocks flirting with highs, new highs, but yet yields have been ticking back up lately. So again, where we go from here, I think will have a big impact on where the stock market goes. There's TYX. TNX is the 10-year. We can look at a couple boards. Same thing. It broke this price channel right here. There. I know this is a busy board. That's why I'm doing this. We had a little uptrend line here. We broke it. So yields started to go back down, but then boom. Now they're currently back testing. You can see I have resistance levels along the way. Let me look at the bond itself, IEF. There's the 10-year bond coming up on support. But what we could see, wouldn't surprise me, and I'm actually leaning that way, is a back test to this trend line. And that's a pretty big trend line right here. You can see the downtrend line I'm referring to. Comes off that high right there. And so that would take the 10-year down, mainly bond prices, meaning yields going up more, and that would be a back test. Anything much more than that, to take out that trend line is going to be quite bearish, and then we'd be running towards the previous lows on bonds, recent high in yields. Let me just look at the weekly chart, make sure I cover all time frames. We're coming off a big divergent low, so there was the best technical case I could make in years to go long bonds, and we did. But and that could certainly play out for more. This is a target that I do believe will be hit in 2024, and that's quite a bit higher. So, however, as I've been saying for a while now, I think at some point, whether we come down or not, I think at some point we're going to see kind of a transition from yields falling. Remember, if IEF is going up, yields are falling as bond prices are rising. And right now that's being taken as bullish for the stock market because lower rates. But at some point, I think we'll see the market roll over and you'll see bonds going up, yields falling due to two factors. Falling economic growth expectations, number one, that's what causes yields to go down and bond prices to go up, as well as a flight to safety. If institutions, i.e. hedge funds and pension funds and all that, they think the stock market's going to go down, they will move money into the safe haven treasury bonds. By buying those bonds, all that buying pressure, money flowing in, causes prices to go up, which causes yields to fall. So that's where I think we're headed. That's kind of a longer term macro outlook. Short term, I live in the world of the 60-minute charts. So I showed you yesterday right here on IEF. We had IEF at the uptrend line, and 95 support. So far we're holding up relative right on that level. That's one reason I think the stock market's up. It's anticipating we'll probably bounce off that level. If we do, great. It supports this rally today and maybe a little more next week. But if not, if we break that support, that's where I think the stock market's going to be surprised and not happy. So there's IEF, pretty much to look at today's lows. You don't want to see it go over there if you're bullish on stocks. Coming up on T1 zone here. Remember, these were the long targets from going long right here. And then I can't even remember if it was here or here after we hit T4. I didn't short it right away. I put it on as a short, I believe, right there. And then we put in that divergent high. Then we broke the trend line. This is that price channel on yields that I showed you, but in reverse. Remember, the price channel on Treasury yields was a downward channel that we recently broke out of. I covered that just a minute ago. And so this is the price channel on the 30-year Treasury bond ETF in reverse. It's a bullish price channel, which we broke there. So you had a break of support, sell signal, and we've been consistently moving lower. However, we are now, for all intents and purposes, we've just hit my first target zone. Remember, I always say cover a little before the actual support level. I have a target zone T1 at 93 down to 92.14. And you get close enough. We hit a low of 93.26. 26 cents on a 93-point security is a fraction of 1%. So again, for all intents and purposes, that now the way you trade it, because it is a zone, we could certainly go lower. We can go to the bottom of the zone. Anything's possible. It just what this tells me at this point, lower stops to protect profits. At that point, no more than right here. I would have a stop if we do have a kickback rally, and you're holding out for more downside. Max bounce stop would be a little bit above that. Actually, I'm going to take that line. I'm going to move it, guys. I'm going to put it right here. I did that for a couple reasons. We have reaction highs here, reaction low there, and a gap right there. So about 96, give or take, is resistance on the 30-year. So I can make a decent but not great case for a bounce. All I can tell you is that should be net bullish for the stock market if TLT does that, and this should be net bearish for the stock market. Again, so that's kind of next week's outlook and maybe the following week. My convictions, again, aren't too strong. I put the odds at elevated for a bounce now or very soon because we are coming up on that first target zone. Let's go and look at some other bonds. Let's just rifle through these charts. I really haven't even updated all of them, but I track them every day and these lines here. So this is J&K junk bonds. Junk bonds, for those of you not familiar, are the one class of bonds. We have different types. We have corporate bonds. You have, and within corporate bonds, you have high investment grade corporate bonds, and then the below investment grades, i.e. junk bonds. And so that's J&K or HYD are your two junk bond ETFs. And then you have muni bonds, you have treasury bonds. The junk bonds are the only bond class that trade much more in line with the stock market than they do interest rates or other bonds. So consider this, and that is because their yields are so high, but their credit quality is so low that they're very sensitive to the economic cycle. If the stock market's doing well, junk bonds are usually doing well. Now we can watch this for clues. You look at things like credit spreads. I'm going to put an alternative line here. I can see we had a trend line here as well. Either way, we put in a divergent high there. I have a minor support level. This is better support here at 92.91, and I think we're going to go down that way. And so this is another thing to watch. What you're seeing real quickly. Let's do this. Let me go here. Let me go to this. And so this is telling me something right now. QQQ, which is the king of risk on indexes, right? It's going up lately while junk bonds are falling. Let me do one more thing. Let's all right. What I did, I wanted to compare it to TLT, the Treasury bond 30-year ETF. TLT is falling more than JNK. Okay, so that means credit spreads are not rising. That's a net plus for the stock market. What you want to see, and when you see junk bonds going down in price more than treasuries falling, that means credit spreads are rising. That's the difference of what a junk bond pays above and beyond a treasury bond. and what they call the risk-free rate of return. So there's no red flags there right now, at least from that simple view. There's other charts you can Google and get credit spreads that are a little more accurate measure, but that's the quick way to do it. I kind of eyeball treasuries and junk bonds, and I can tell when credit spreads are widening based on the performance between the two. Fallen, divergent high. This was one of all these guys got distorted. This was one of the bond fund ETFs. The Fed pulled out a rabbit out of their hat when COVID hit and invoked some obscure emergency powers that were available to them and allowed them to actually go in and directly manipulate and buy ETFs and other things that were outside their normal purview. And this was one of them. I remember they bought this one. I don't know. So what they did is they really destroyed price discovery in the process, and that was here on COVID. And that's why we had such a huge drop in bonds. That almost can't even trust what the bond market's saying now. Although they are unwinding, they have been unwinding their balance sheet. Either way, I'm digressing here. I just wanted to mention that we did put in a divergent high at resistance. This is a line I've had here. It's not just put on here recently. I created that back in April of 2019. It was resistance and support back then, right here. It goes all the way back. So it's a pretty significant level. And we did so with negative divergence. So I think this one will come down. So the bottom line is I see more downside, especially on these corporate bonds. FALN is corporate bonds. And let me show you a couple others. SHY, that's short term. I'm not going to spend too much time on that. That's a short-term ETF. I'm just clicking my watch list, guys. I'm going to go through some that don't matter. Like SJB is just the short of high yield, but I already covered high yield via JNK. And there's LQD. This one's interesting. I watched this one closely. LQD are investment-grade corporate bonds. That's what this ETF holds. And I've had this line here for quite a while. A downtrend line that came in here, connected these 2 points, and recently hit this, and we got rejected. We also recently broke down. We had a little wedge here. I covered this in a recent video. I said back here that we had what appeared to be an imminent or likely bearish PPO crossover, and if you look real quick, we never got it. That's why I put the little X there. The lines kissed, jumped up. I see this quite often. I see it looks like the lines are going to cross. They turn down and they bounce, but inevitably, especially when you get the PPO in a high level like this, you get a crossover. So there was your sell signal, and I covered this in a video not too long ago, along with treasuries, where I said it's a combination of overbought, and I used the purple line on LQD. That's the extreme overbought reading. So when you get overbought, and that's at 77.45, not the traditional 70 level, this is what the magic number is right here, and has been. And so you had these tags here, here, and here. Those were the last tags all the way back here, and they were golden shorting opportunities. But what I like to see too is that bearish crossover, and so far we got it. So that put LQD, the corporate bond ETF, on a sell signal, and corporate bonds have been moving lower as well. And a little bit of, I would be remiss not to put it. There's some support right here. You have all these reaction highs there and some reactions there. So we're coming up on support. So a bounce likely, yeah. Maybe the end of the correction, possibly. All I'm trying to say is if not, we go through that support level and we keep moving lower. This is what's going to increasingly put pressure on the stock market. So these are things to watch. And then for the bull case, you can see a breakout above that trend line or the recent highs. That should be bullish. Next stop would be probably up there. This is HYD. That's the Municipal Custom High Yield Composite Index. So these are high yielding, aka lower quality muni bonds, and put in a divergent high recently. And it's been moving lower, and really big supports down here. You have 50, about a little over $50, and then this downtrend line right here. So, oops, I didn't mean to move that. Back, and then the downtrend line. So I'm watching this, and I think there's a decent chance that continues to move lower. Again, maybe a kickback before we get down there, but that's certainly a possibility. MUB, This is a big one. This is the kind of the go-to muni bond ETF. Well diversified, a lot of different states in here, so it's kind of a easy proxy for the muni market. Big, 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 big resistance. Look at that level. That goes back all the way into 2022. It's capped every advance in MUB. So again, it went into, I didn't cover it at the time, but when we shorted treasuries, because there's more juice. We got, TLT is my proxy for treasuries, and TLT has fallen 7.39%, plus you usually double that position, so that's about a 15% gain so far. MUB, you're shorting munis, they're steady eddy, they pay a lower rate, so they're not as rate sensitive, and it's only dropped 1.25%. However, what I wanted to point out is, look where we fell from. Look what happened the last several times we got to this level. So the market right now thinks rates are going to continue lower and we're going to have a lot of cuts, and maybe so. And like I said, I suspect so too. I fully expect cuts from the Fed this year again, but I think it's for different reasons. The market's treating it as bullish. I think it's going to be from economic weakness and or any problems in the financial system, maybe something Powell already sees, who knows. All I can tell you, this one's at support now, so maybe a little bounce here in bonds, which means pullback in rates, so maybe a little more upside in the markets next week or so. As I've showed you recently, the markets are more conducive to active trading. Since early December, they've been in a range, so let me see if there's anything else. PCZ is that California Muni bond fund I was covering a long time. California, I have little doubt, will be facing some major fiscal problems in the coming years, including but not limited to their massive. They have the biggest pension fund in the world, at least in the entire country, and probably the world, CalPERS, public pension system, and who has been grossly underfunded, like so many other. And the taxpayers of California are on the hook for the shortfalls. So anyways, it's a trend line we hit recently. It goes all the way back to here, 2021. Hard rejection. And just like munis or treasuries, you had a beautiful little price channel, broke down, back test, and we've been moving lower. And I don't really have much support on PCZ until all the way down to 675. So keep an eye on that one. Okay, so in summary, just to wrap it up, bonds treasuries are down today, not a whole lot. This is TLT down 0.14, meaning yields are up a little bit. IEF is also down, and yet, and that's being reflected, by the way, small caps are the most rate sensitive, so they're down 0.5% because of that, most likely. But yet QQQ just doesn't get the memo. It's up 0.92%. So either these folks buying these tech stocks are correct and bonds are going to reverse and rates are going to continue to fall substantially. But I can all but promise, can't ever make a promise in this game we call trading and investing and analyzing the markets, but I can tell you with a high degree of confidence that should rates continue to tick up from here, again, above the recent highs, it's incremental and progressive that if and as rates continue back up and start to run anywhere towards those recent highs we peaked out on, you will see a rush for the exits. It starts probably with a break of the trend line, then a break of this level. And again, it's like I said, it's how much. The higher we see rates come in the near term. We also still need to see some technical levels break. Apple I should cover, and then I'll wrap up. We're coming up to that. Remember, this was a long here off this divergent low. We hit the first target, put in a second, and still divergent low at that same level right there. Strong divergence. We're coming up now, so we're probably going to hit it. So if you're looking at where this bounce might stop, we're getting very close to, I had that T2 zone. In fact, close enough, really. If you held it and you were holding out for T2, you only have another half percent upside till you hit the bottom, like second target zone. So I think that's probably going to be it for Apple, be my guess. And then everything else, Microsoft already broke down, a little snapback rally after breaking down from the wedge. Maybe we put an alternative trend line here, but all I can tell you, it's still extending the divergence that we had in place. So Nothing, I repeat, nothing has changed on my outlook, despite the fact we're up a little again today in QQQ. The technical posture on all these stocks remains the same. Negative divergence anywhere from the 60-minute charts, which we're looking at here, all the way out to the daily and weekly charts. And so I still think something's coming, whether it's simply a break, these tech stocks collapse under their own weight. That's a possibility, or there's a surprise in the market somewhere, or it's interest rates. These are things that are likely catalysts. If you're wondering what's going to stop this, again, I wouldn't even call it a freight train. The market, like I told you, is kind of stalled out, and it's trading, where it was a few weeks ago, back in late December. And these highs are incremental, and the divergences continue to build. So we're really not going very far or fast. I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.